Are you giving in the most tax advantage way? Are you giving when you're making your charitable contributions? Are you doing it in a way that gives you the biggest benefit on your tax picture? I know that's not why you're doing it, but are you getting all those goodies? I'm going to tell you how coming up. My name is Mike Bernard. I am the host of the Wise Money Show. I'm also one of the certified financial planners right here at Corhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Okay, I don't know when you're consuming this, but right now I'm recording it. It is the season of giving. We are in the middle of the holiday season, and we do tax planning here. Your certified financial planner should be doing proactive tax planning with you, making sure that you're taking advantage of all of the opportunities for you to pay the least amount of tax, yes, this year, but more importantly, over your life. And really what should be connected with that is a giving strategy. If you donate to any nonprofits or charities, you need to be mindful of, are you making those donations in the most tax efficient way? Is that the reason you donate? Probably not. For most of us, no, we don't donate just to get a tax benefit. We donate out of the goodness of our heart, and we're trying to support some causes we really care about. But are you doing it? Are you making those donations in the most tax advantaged, tax favored ways? Well, I'm going to share 4 different tax strategies for giving. I don't know if any of these fit in your situation, but I'm going to share them, and then you can see whether they would, but then you can also work with your certified financial planner and say, hey, what about this strategy? What about this strategy? So the very first one, to make sure that you're giving in the most tax favored way possible, this year, we've seen the most unbelievable drop and then rise in investments, at least that I've heard. It's been the most unusual year in the investment world in my 20-year career. I think it probably goes back to, it's the most unusual year since 1987 in the markets. But what that means is, if you have a brokerage account, an individual investment account, or a joint investment account, not an IRA or a 401k, we'll get to that, but if you just have an individual investment account, okay, likely you hold some stock that has gone down in value and then gone way up in value, and it might have a big capital gain. So the first consideration to make sure you're donating in the most tax advantaged, tax favored way is, if you've got that scenario, highly appreciated stocks or mutual funds in a brokerage account, consider donating those shares instead of cash right out of your pocket. If you're donating those shares, you get the full write-off for the value of those shares. All right, so if you're itemizing your deductions, you get the full value of whatever the market value is on your Schedule A in your itemized deductions, but you're not the one selling the shares and realizing the capital gain. You donate the shares to the charity, to the church, and that church then sells the shares, and they then have the cash. Well, what's the difference, you might ask? Well, if you sell the shares, you've got to report that capital gain on your tax return, and unless you're in the 10 or 12% tax bracket, you're going to have to pay tax on that, right? But a nonprofit doesn't have to pay the tax on that. They receive the shares from you, they sell them, and they don't have to pay capital gains tax. So I think there's a lot of people that have these highly appreciated mutual funds or stocks, but they're still donating to these causes out of pocket. Well, you could donate your stock and then use that cash that you were going to donate to the church to buy back into those shares. So you get the full write-off for the market value, you just don't have any of the tax paying. And every year this is a tax opportunity. It's a way to donate in a more tax-efficient way. But this year especially, because of the wild ride on Wall Street, this one, make sure you consider it. Now, each of the giving strategies I'm going to talk about relate to giving to nonprofits, but this is another one. If I were to go to a second point here with this donating highly appreciated stock or mutual funds, I would also consider doing that for your kids as well. If you're in a certain tax bracket and around this time of year you give $5,000 or $10,000 or whatever to the kids, but the kids are in a lower tax bracket, consider giving them the shares of stock. When you do that, you give them your basis as well. So then But when they sell the stock, they'll have to report that gain. But if they're in a lower tax bracket, it may be more advantageous for them to sell the stock, and you use whatever cash you were going to use to give to them. You use that cash to rebuy those shares if you still want those holdings. So highly appreciated stock, highly appreciated mutual funds. That's the first unique giving idea in a way that can help you improve your tax situation. That's the first one. Second one only applies to folks that are over the age 70 and a half. That's right. There is that limit within this rule within the Internal Revenue Code. But if you are age 70 and a half or higher, you can donate money directly from your IRA, directly to a nonprofit of your choice, and you can do so in a way that withdrawal, that money going right out from your IRA, does not land on your tax return. It is a tax-free donation. Now you might say, well, wait a second, I just give cash, or mom and dad, my folks they just give cash to the church. You know, it's no problem. And yeah, they withdraw money out of their IRA, and I guess it lands in their checking account, and then they donate to the church or donate to these causes. No big deal. Well, they've got to report that income as they withdraw money out of the IRA. They've got to report that income. And then as they make contributions to the church or the nonprofits, most likely they're not donating enough to actually itemize their taxes. So they're having to claim the withdrawal of the IRA as income, and they're not getting any tax benefit for the donation. So one way is to just cut out the middleman, cut out mom and dad, or cut out yourself from that equation. Just send the money directly from the IRA directly to the charity. When that happens, that is not included as income. So it's a way of getting a deduction on your tax return. I bring this up because I don't know if there's a lot of folks 70 and a half that are listening to this channel. So if you are, definitely consider this, okay? If you're not, and you're thinking of your folks in this situation, I mean, I would turn them on to this video, or I would talk to them about this idea. It's called a qualified charitable distribution, qualified charitable donation, either one. I've seen both, a QCD. And so work with your certified financial planner on that. The third item is very similar to that one, and that is opening up a donor-advised fund and donating into a donor-advised fund. And I tell you, so this one, I'm actually going to do the third and the fourth idea together at one time. So the third idea is using a donor-advised fund, basically creating a giving account and donating money into this account that you still have some influence over. It's one of your accounts, okay? You donate into that, and that's when you get the tax write-off. But then you then have some influence over when the money in this account gets dispersed to the end charity, the end organization. And you can throw $50,000, you can throw $30,000, you can throw $130,000, whatever the amount is, into this donor-advised fund. When you make that donation, that's when it gets a write-off on your tax return. So by putting a big chunk in there, you're more likely to be able to write that off and itemize your deductions. But then you can donate that money out of there to all sorts of different places. Doesn't need to go all to one organization, and doesn't need to go all at one time. You can spread those donations out of your donor advised fund. You can donate and give some money to this cause, this cause, this cause, this year, next year, 3 years from now, 4 years from now. Okay, you've got a lot of control over there, over that. So donor advised fund is a way of donating a big chunk of money all in 1 year, but then still having some control over the timing and when that money is dispersed to the end charity. So that's the third tax efficient giving strategy, is using a donor advised fund. And the fourth idea the final idea I wanted to mention is connected to that, and that is, if you, let's pretend, for example, each year you give around $10,000 to your church, okay? So every year you give $10,000, and that alone in and of itself, that much giving isn't enough for you to itemize your taxes. But if you were to somehow do $20,000 in donations this year, and nothing next year, and then $20,000, and then nothing, then $20,000. Ultimately, it's the same amount that you're donating, but $20,000 in 1 year, yeah, that would allow you to itemize your deductions when you're connecting some other deductions. And so how can you donate $20,000 in 1 year and then nothing the next $20,000? I mean, so this idea, it's called bunching your donations. and bunching them together into one year. And one great way to do that is using a donor advised fund, throwing $20,000 into that donor advised fund and then dripping it out 10 years at a time, but then throwing $20,000 in there and nothing the next year. 20,000, and I'm just using 20,000 as an example, but that fourth way, that fourth tax strategy to improve your giving is bunching your contributions, and using a donor advised fund is a great way to do that. So I hope that helps. Those are 4 different sort of creative ideas on how you can do your donations, your giving in the most tax efficient ways possible. Now, is that an all-inclusive list? No. Those are the common 4. There's more though, and then whether it's one of those 4 or 2 of those or any others, should you be doing them? Well, that's a question. That's a certified financial planning question. That's a comprehensive financial planning question. So work with your CFP to see, should I be incorporating any of these, or is there some other creative idea that I should be considering with my giving to improve my tax situation? Work with your CFP on that. If you don't have a CFP, you want to talk to one of the ones on my team, you can do so. You can find us online, korhorn.com, that's Korhorn with a K, or wisemoneyshow.com. We've got a full team of CFPs here, as well as a team of CPAs collaborating together. We can dream up some pretty creative tax strategies for you. So reach out to us that way if you don't have someone on your team. You can also just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.